Hey guys, and welcome to the podcast today. I'm really happy to introduce to today's sponsor, Laxman. He is co-founder of DocWealth, and we're going to hear all about DocWealth for physicians who want to accelerate financial independence with strategic tax planning. Laxman and his co-founder have a very fascinating backstory, how they founded DocWealth, and I'm really happy to have him on to share more. So, Laxman, welcome.
Thank you. Thank you, Chris. Happy to be here.
Yeah. And briefly introduce yourself and we'll
Yeah,
dive into the questions.
definitely. I'm Laxman. I'm a co-founder of DocWealth from Florida originally, but my background's a CPA, been in accounting for a while, and then worked in Silicon Valley for about 10 years in a variety of tech companies.
Yeah. And really, I know you've been featured on platforms such as White Coat Investor, Physician on Fire, and trying to spread out the good news. What led you to co-found DocWealth, to start DocWealth, and what does it do?
Yeah, that's a great question. So my college roommate is a physician. He's a 1099 Locums emergency medicine physician. And about a couple of years ago, he called me and said, "Hey, I'm trying to find a CPA or someone to help me lower my taxable income. And I'm not really able to find someone that specializes with physicians or doctors or really medical professionals. I'm getting a lot of different strategies and I need a little bit more handholding because I never taken any finance courses in residency." I didn't know any on the top of my head. So we got on a bunch of calls and spoken to different companies, and nothing really felt right. So we felt that, okay, there's a pretty large gap in the market if no one is serving medical professionals and physicians. Maybe we should just create it. And we're both pretty entrepreneurial. I worked in tech. I was surrounded by just startups everywhere. And my co-founder, Mark, he has a PhD in engineering and became a medical physician. So we decided to build something that was really catered to this niche that really solved a need. And so that started about 2.5 years ago. And now we work with over 1,000 physicians. So we've grown pretty rapidly.
Yeah, amazing story. And I love how you focus on one specific subset and one specific problem. And are all physicians who works with DocWealth, is it the hedge funds? Is it the angel investors? Is it the real estate? Is it the mom and pops? Who do you serve?
Yeah, so we work very much, I would say 90% are physicians who have some sort of 1099 or business income or in real estate. The other 10% typically own their own practices or pure W-2. But everyone has the same problem. How can I minimize my taxable tax liability, but in a legitimate, compliant way? Because there's a lot of social media that says, hey, you can buy insurance policies, you can do conservation easement. The profile that we work with is very much wants to be compliant, be within the tax code, but maximize and leverage the tax code to its full ability. And so that's what we do. And we basically create a one-stop shop of bring in tax attorneys who are fully versed in all the tax compliance and strategies, and then a bunch of CPAs and enrolled agents who are work on the tax strategy side between real estate and every tax strategy that you probably have heard of have a pretty extensive background. So we have a team of over 25 now. And so we just collected experts in every field from entity formation, payroll, bookkeeping to be able to do that.
The other question I have for you is what tax strategies are most commonly used by your clients to mitigate their taxable income?
Yeah, that's a great question. So I would really say it's two buckets. Are you W-2 or do you have business income? 1099, you own your own practice, owning real estate actively. W-2 is very limited. The tax code heavily favors those that are business owners or have business income. But W-2, it's more along the lines of having to invest in certain asset classes that you can basically depreciate, accelerate depreciation, or defer it to a later point in time. And the basic concept is money is more valuable today than it is later because we have inflation. So $1 today, 10 years from now could be the equivalent of $2 at that point. And so the most common in W-2 is real estate. That could be many heard of the short-term rental loophole. So that's buying a short-term rental property, typically an Airbnb or VRBO, and then you're able to do what is called a cost segregation study, which just accelerates the depreciation of the property. And not to get too in the details, but you're taking the property's value, say it's 500,000, and you can probably do 25% in the first year. So that's 120, say $500,000 property, it's $125,000 that you're deducting against your W-2 income in year one. And based on your tax rate, that could be $30,000, $40,000, $50,000 in cash that you can deploy. And then I would say there's a couple other, mostly around investments like oil and gas, opportunity zones. But 1099 or business, the world is your oyster, because everything that is ordinary and necessary becomes something that can be expensible.
The other question I have for you is, so for example, a lot of, because I know a lot of doctors, their spouses, there's the, what is the real estate professional, and they get the other, they buy this rental property, and then they get the spouse to qualify for rep status, and it decreases their taxable income. Is that, how common and how legit is that strategy?
Yeah, there are definitely, typically when you are trying to write off more as in a real estate professional status, there are definitely compliance rules that you need to follow. Uncle Sam is not just going to let you keep your money. So you got to make sure you check every one of those boxes. And that is a great strategy. It's a legitimate strategy, but you have to follow the rules. And so long-term rental and short-term rental have two different sets of rules. The more difficult one is doing the long-term rental, because you have to get rep status. You have to show 750 hours in the year that's documented towards that real estate activity. You're basically saying that your dominant job is real estate. And so that's how you qualify. And this can be pretty difficult. This is a very common strategy, especially if your spouse is part-time or stay at home. It's definitely doable. But you have to be able to log the hours. And if you're able to do that, you can do what I mentioned before with the accelerated depreciation and do the cost extension.
The following question I have for you is, how long has DocWealth been in, how many physicians, how much in tax savings, any success stories, and what separates DocWealth from other tax professional advice?
Yeah, so DocWealth is pretty unique in the sense that we really built this company from the client or physician perspective. And what that means is most times when we were talking to different companies, they were like all doing the same exact thing. Okay, this is how we do the tax, and working with a variety of different profiles that have different risk profiles, different strategies that make sense. And you, as a generalist, you can't really be very proficient or if you don't go down that niche. And so what we did was we spoke to probably over 1,000 1099 medical professionals or real estate investors in the medical space and said, hey, what are you missing with your current tax professional? There was 3 pain points. And so we built the entire company around those 3 pain points. One was, I can't get a hold of my accountant, my CPA. It takes weeks. I never hear from them. That was over 92% that said that. So we ensure a 48-hour business hour response rate, which no one ever commits to, but we have it within the entire team and we are consistently providing that. The other thing is that we wanted something that was very education focused. So teach a person to fish, feeds them for life. That is a big philosophy here at Doc. And so we are constantly adding to our education platform, where as we work with 1,000+ clients and doctors, when we see success stories, different tax strategies, we're always including that within our education platform. And everything is very simple and accessible. Everything you can understand within probably 5 to 7 minutes max, because we didn't want to have this huge, long video that you would take 20, 30 minutes and no one would ever go through. So that was the second perspective. And the third is just having a very proactive, hands-on approach throughout the year. So you can reach out to us anytime throughout the year. There's no nickel and diming. So we have a flat fee structure. It's a subscription model. You pay that structure, and then you can really reach out and use all the facets of what you need related to tax and accounting. But yeah, that's what's really made us unique, and only being around for 2.5 years, working with well over 1,000 clients at this point. So very fast adoption. And I would say probably 70% of that has been all just referrals of each other, which is, I think, the most important metric.
Yeah. The other question, because you mentioned earlier that you are focused on the 1099 and the physicians earning business income, the practice owners. One question I have for you is 1099 physicians, a lot of locums, ER, anesthesia. Should they do S-Corp or LLC?
Yeah, I get that question quite a lot. And I've spoken to our tax attorneys at length about this. And I would say if anyone quotes you an exact number of 70,000 or 100,000, there's no right number, right? It really depends on all the variables of your personal situation. Do you have kids? Are you married? What is your total household income? But S-Corp can be very powerful. Typically, it acts as a bell curve. After a certain income limit, it starts to yield many benefits. And then if you start making too much, it probably starts to phase out. But what an S-Corp at its core, what it's able to do is that it splits your income. Say you're making $500,000 into a W-2 and then a distribution. And the distribution does not have to pay payroll taxes or FICA. And so effectively, this is 8-9% on that amount of income. And so it starts to add up quite quickly. But with an S-Corp, it's really important to know that there are compliance items that's a little bit more complex than an LLC. An LLC is what's called a disregarded entity. And so all that really means is that all the income is going to flow down to your name anyway. So there's no real difference, but it's more of protecting against liability of if someone comes to sue you, they can't go after your personal assets. But with an S-Corp, what you're able to do is you have to have a payroll management system. You have to make sure the reasonable compensation W-2 is not too low. So certain things like that. But again, not paying the payroll and not paying the FICA adds up to be quite significant. And it's all a math equation at the end of the day. If I'm able to save more money with the additional headache of the S-Corp, which my accountant's going to already take care of, it's going to be well worth it. So I would say the vast majority are using an S-Corp, especially with us.
Yeah. A follow-up question on 1099 is you wrote a post about tax mistakes 1099 physicians must avoid. Briefly give an overview of what people are doing incorrectly.
Yeah, I think some of the mistakes that I see quite common is it's important to separate personal and business expenses. Many times I see someone using the same credit card for personal and business, and they think, oh, I can just show my bank statement. That's incorrect, because for the classic example I use is if you go to Costco and you swipe for $250, who knows if it's a laptop for work or if it's groceries. And so that doesn't qualify as a deduction or expense, right? So it's really important to keep a good structure of business within the business credit card and making sure it's all legitimate business expenses. And that can be anything that's ordinary necessary to generating that income. But there's a long list on that side. The second one is probably around the home office. If you have a space in your home that is enclosed and you can say is dedicated towards doing work, then that's something there where you can start writing off the mortgage, the interest, utilities, all the expenses related to that, which can add up as well. But it's very important. This is one of the highest audited items that you don't start claiming your living room and kitchen and stuff. So it's got to be definitely defendable. And then I think ultimately the last one is really looking at, does it make sense to have an S-Corp or not in doing that evaluation? Because many people just think, oh, I'm just going to get paid to my name and I'll be able to maximize things. But the tax code is like thousands and thousands of pages. And so each state has its own rules, PTET, SALT deduction, the big beautiful bill. So just at least even getting a consult or understanding, hey, for my state, what can I do and how do I navigate it? Because knowledge is power and money at the end of the day. But that's what I would say is probably the most common.
Yeah, these are really great advice. And we'll talk about how the big beautiful bill impacts physicians coming out, as well as kind of year-end tax planning moves. For people listening to this, they may be their final year of residency and they're getting job offers. Should they take the W-2 versus 1099 for their first attending job?
Great question. So we actually worked with about 200 new graduates this past year who became attendings. And that is probably the most common question that I got. And I would say if you are willing to, if everything, all this is equal, W-2 to 1099 income, you're going to be able to save a lot more because of how you can structure and what you can write off. Then it becomes a math equation if the 1099 is less. But overall, the 1099 or locums will allow you to contribute so much more to retirement accounts. With the solo 401k, you can do up to 70,000, for example, versus 23,500 for 2025 limits for 401k. You're able to do the home office. Many of them are finally starting to buy a car. You can expense, if it's over 6,000 pounds, it's up to 100% of the entire car with the big beautiful bill. So if it's over 6,000 pounds, you're buying an SUV, you buy a $100,000 car, the percentage of what is business, almost 100%, all 100,000 is deductible against your income. You can't do any of that with a W-2. So it's really about understanding and knowing that you have your structure, what you can do, how do you execute it. And then when the filing comes along, you have to make sure that you know how to file, because the TurboTax is great for W-2, but it is not well equipped for all the nuances of the strategies that you're probably doing.
Yeah. The other question, because you mentioned the car with the big, beautiful bill, what other items or aspects of the big, beautiful bill benefit physicians, either W-2 or 1099?
Yeah, I would also say the 100% bonus depreciation with the assets, like real estate, for example, is a big one. We saw so many real estate purchases happen in the second half of 2025, because you have 100% bonus depreciation, and then it became 40% previously. So that's probably one of the biggest ones. The other major one is, I would say, the big beautiful bill really helps those that are making in that income range of 200 to 600,000 predominantly, because of the SALT, of the increase in the SALT limit from 10K to 40K. And I'll keep it really high level of what this means. But basically, if you live in a state that has high property tax, high state taxes, this is going to be huge, because previous limit was you can only deduct up to 10,000, right? Now it's up to 40,000. That's a $30,000 increase. It starts to phase out after $500,000 in gross AGI if you're married filing jointly, and that starts to go down. But that's why I say that 200 to really 600 is you start to benefit from that, because you can start to offset your federal income tax by using the SALT, which came through.
Yeah.
But I would say those two are probably the really big ones that I've seen get implemented a lot recently and going into 2026.
Wow. And when you say SALT, people that aren't familiar with that term, what is that?
Yeah, that's basically like the state tax, including the property tax. And so it's basically accumulating all those things together, essentially.
Yeah. Excellent. The other question is, I know it's December 4th, and so what for those doctors or that haven't been planning tax, what are some quick, efficient, simple tax moves to make before December 31st to lower their tax bill?
Yeah, I always say that tax planning and tax write-offs, you want to have everything pretty clear in the tax year. I know tax filing will happen April 15th or afterwards. It's too late really to do the vast majority of write-offs at that point in time, because everything has to be documented and done really in the tax year that you want to deduct it. And for example, if you have any equipment, any scrubs, any CME, any travel like that, make sure it's being expensed and you have the receipts in this year itself. Solo 401ks have to be set up this year. You cannot wait till January 1st, or it won't be set up in time and you can't contribute. I've seen that mistake happen many times. But overall, the goal is try to get ahead, start as early as possible. For example, like we've already started 2026 planning for all our physicians now itself in November with, okay, what are the entity structures? What should you do? What do you want to get in for 2025? But solo 401k, any expenses, make sure that you have the receipts, organize those things. I think that's probably the key things to do in these last couple of weeks of the year.
Yeah. The other question we have is, for example, a lot of the audience, they keep their receipts, and then they send they send it to their tax accountant, and their tax accountant prepares it. But what you're offering is actually strategic. For example, invest in this because of the big beautiful bill that'll cut your tax bill. For those coming out of residency or those still in their early stages, what is your advice for tax advisor? Is it just those that fill out the form, or like actually give strategic advice? And how does DocWealth fit that need?
Yeah. So I think it comes down to really two words. Are you being reactive or are you being proactive? And reactive is typically what we've seen is like many tax firms are just collecting documents, inputting into forms. Honestly, TurboTax and AI will do that for you. Tax planning is something that is being proactive. You're looking at your personal situation. What do you have going on? And this is where you are able to actually create savings versus tax filing just being a cost that you pay every year. These planning, these savings will yield a tremendous amount of cash savings that will compound every year that you do it. And for example, many of the physicians are going to be entering into the highest tax brackets, and many with state taxes. And so even if you're able to deduct 10,000 in a year, which is a pretty low bar, that's $3,700 in cash back in your pocket. And you compound that for the rest of your career until you retire, you do the math, that's going to be hundreds of thousands, if not millions. And so we're able to look at the situations, optimize, and many times get 30 to 100,000. And so it pays. That's where you get to, okay, this is well worth it because I'm getting an ROI. I'm getting a strong return on my investment that's going to create savings for me at the end of the day.
Yeah. We do have a question from the audience. One thing is, and then they said that it sounds like you help the high income earners, the early career. What about, because he's an older practicing, he's generated significant wealth, net worth is tens of millions. At what point should physicians start thinking about trusts and partnerships, these sort of legacy planning vehicles?
Yeah, I would say creating a trust earlier is probably better because as you're accumulating assets, it's a lot easier to have all those assets be part of the trust from the beginning. I've worked with many older physicians, including my honestly own parents, who created a trust only 5-10 years ago. And it was quite a hurdle of organizing everything and getting everything into trust. But a trust, if anyone doesn't know, it protects your assets and it ensures that whoever you want to pass it down to, whether it's your kids or family, it bypasses probate court, which can be extremely expensive, have tax liabilities on that. And so a trust, you pay that one-time cost to the lawyer to set it up, but it's a very good structure in protecting all your assets, especially as you're building wealth and buying real estate or any other investments. I recommend doing it as early as you can from the very beginning. It's a good habit.
Yeah. How can people connect with you, email you, contact, learn more about DocWealth, see how it supports their needs? And I know you have a special affiliate code or offer for the audience listening.
Yes. So I think we shared our link with you as well. You can find more information about us on our website as well, docwealth.io. And yeah, look forward to working and really preserving everyone's wealth.
Yeah, excellent. Thanks so much. I really enjoyed this and conversation and love the work that you're doing, and keep up the great work.
Yeah, thank you. I appreciate your time too, Chris. Take care.